In this presentation, we will work a problem putting together a statement of revenue, expenditure, and changes in fund balance for a capital projects fund. The information is going to be on the left side. We're going to use that information to fill out the blue area on the right side. On the left side, we have our trial balance. Our trial balance is going to be in order: assets, liabilities, what would be the equity for a for-profit organization, fund balance section here, assets minus liabilities, light blue. Then what would be the income statement for a for-profit type of organization, temporary accounts, those accounts we would typically expect to close out to what would be for a for-profit. The equity section is going to be in the dark blue down below. Note we could have some other accounts within the funds which could muddy things up, cloud things up, in this case, such as encumbrances, which is kind of a budgetary account. I would think of it more as kind of a clearing type of account. We here focusing on the statement of revenue, expenditures, and changes in fund balance, then focusing then in on these dark blue accounts. This is going to be kind of like the income statement equivalent for the fund balance statements of the capital projects funds, a governmental fund, a fund that uses a modified accrual basis as opposed to an accrual basis. Okay, so let's go through this. We're going to start off where we would expect revenue. Revenue's up top. We're going to say this is going to be equal to the revenue amount, and we're going to pick up the revenue. Now we've got the credits are represented with negative numbers here, the debits with positives. So we got the debits minus, or the credits minus the debits. In this format, the debits are winning for 23,100. However, we got to be careful for this encumbrances item because that may not be included in the statement of revenues, expenditures, and changes in fund balance, because it's really kind of a holding account until we can actually record what we want to, which is the construction expenditure. So we want to be careful of that. Encumbrances account, notice the equal and opposite portion of it will be up here in what would be equivalent to like the equity section, the fund balance type section, the assets minus liabilities type of area. Okay, so I'm going to pull over the amount. I'm in E5. I'm going to say negative to flip the sign. Actually, that's the wrong spot. I'm in E4. Negative to flip the sign. We're going to pick up that 751,600. That's going to be our first number. Then we're going to go to expenditures rather than expenses because we're on the modified accrual basis, colon to indicate that we're going to have more than one here. The first one we're going to pick up is going to be the construction expenditures, and that's where most of them would be, we would expect. And we can go ahead, I'm going to put a little yellow item. We've picked up that number, and we've picked up this number is what we're going to now. Notice we're going to actually tie back out to all of the blue accounts in a way, because we're going to tie it back out to the fund balance at the end of the day. So if we find a home for all of these items or an equivalent to it, we'll talk about encumbrances outstanding, which will muddy things up a bit. Then we'll get to this number here, 1,647,000. So that's kind of our objective. You can think of the end game of the puzzle there. And so as you put this together. So then we're going to go to the construction expenditures is going to be equal to this item. And then we got the excess of revenues over under expenditures. So we're going to subtract these two out. And that's going to be equal to the revenue minus the construction expenditures, which are much higher at this point in time. And therefore we are clearly under. Now this might often be the case because we may get financing sources other than what we would consider normal financing sources in terms of revenue, and we're going to call them other financing sources. So other financing sources, in our case, being the proceeds of the bonds. So we have other financing sources here from the proceeds of the bonds. So I'm going to say this is going to be here, and notice again, proceeds on the bonds are kind of acting like revenue. We're recording them in the statement of revenues, expenditures, and changes in fund balance, the income statement type of financial statement. And so we're recording them differently than we typically would under a full accrual method. This is going to be the modified accrual. We're looking at the flow type of activity. So we're going to break them out into another area, other financing sources. However, they're still acting in a similar fashion as basically revenue. They're going to be bringing up the bottom line of this item. So we're going to say that this is going to be negative to flip the sign of that number. So I want to make it a positive over here. We're flipping from debit and credit format to a plus and minus format as we move this information over. Then we're going to call this line excess of revenue and other financing sources, right? That's the revenue and other financing sources, uses over expenditures. So, right, so we have to use this long phrase because now we have revenues, other financing sources. We may have other financing uses over the expenditures. So we could think of these all as kind of one grouping per se. We could say basically revenue, including other financing sources, and expenditures rather than expenses and other financing uses. But of course, to cover all the bases in our line item here, we have this long description. So we're going to say that this is going to be equal to this item, which is a negative amount, plus this item, and that's going to give us our 1,301,200. So you'll recall that we had the revenue minus the expenditures. Expenditures were higher. That gave us our excess of the expenditures over the revenue here. And then we have other proceeds. So this is going to be a positive or kind of increasing the number. So this came out to a negative balance plus the added kind of revenue equivalent type of item would give us this amount at this point in time. So then this would be the bottom line. However, now we're going to tie this out to the fund balance. And you might be saying, well, why doesn't that add up to this number here? Notice that this number includes the encumbrances, and we didn't include the encumbrances on this side. Why not? Let's add this up without the encumbrances just to prove that. We're going to say this is equal to the revenue here plus the construction expenditures plus the other financing sources, not including the encumbrances. Now we've got the 1,301,200. There's the 1,301,200. So why don't we include the encumbrances? Because that's a holding account that basically we haven't hit the point in time where we could trigger us to normally record an expenditure under the modified accrual basis. At that point in time, we will record the expenditure here. Until that happens, we're going to record it in here in the encumbrances. So what do the encumbrances do? They're going to basically say, they're going to give more information that, hey, we've made a commitment, but we don't have the finance, we haven't actually done anything that was going to trigger the financial transaction with regards to an actual expenditure at this point in time. How can we remove it and still be in balance? Because this is part of the double entry accounting system. How can we remove that and not mess up the fact that our balance sheet won't be in balance? Because this income statement is tying into the balance sheet. It's part of the equity section, or what would be the equity section of the fund balance section of the balance sheet. Because this amount and this amount are always equal and opposite, and we're not going to include either one of them in the double entry assets, liabilities, and what would be equity. We're not going to include them, or assets minus liabilities equals fund balance. We're not going to have either of them there, so we're going to remove both of them. So just keep that in mind. That's kind of the tricky factor. Encumbrances may not be included, and you can do that because we're going to remove both the encumbrance and the related encumbrances outstanding, both what is kind of like the temporary income statement type account and what would be kind of like the equity type of account, or the fund balance type of account. Okay, so now we're going to tie this into the fund balance, which is going to be basically kind of tying out to what would be similar to like retained earnings or the capital account. And what we're going to do by that is we're just going to take in the beginning fund balance. So we're going to say, what was the beginning fund balance? And that's going to be here, and that's going to be coming from, I'm going to say negative to flip the sign. It's going to be coming from the fund balance here. This is the beginning balance because that's what's there before we close out all the other stuff to it. So we haven't closed anything out. That's the beginning balance. If there's no other activity in that account, which kind of like retained earnings, you would think there wouldn't be much activity to what would be similar to the equity account, then that is the beginning balance until we close everything out to it. So there's the beginning balance, and then we've got the fund balance at the end. So here's going to be the ending balance, and we will sum that up. And then that's going to give us the ending balance, the 1,647,000. So once again, if you sum up the whole thing now, if I was to sum up equal the sum of this whole thing, we come up to the 1,647,000, which of course is equivalent to assets minus the liabilities, sums up to 1,647,000. So that would make sense. Our balance sheet is in balance. Assets minus liabilities equals what would be the equity section or the fund balance section. Now you might say, well, how does that work given the fact that we didn't include encumbrances? So note again, we didn't include encumbrances, and we didn't include encumbrances outstanding. We didn't include these two amounts, just to mark that off, and just to kind of make this point very hit on it multiple times here because it can be kind of confusing. If we were to add this up this way too, we could say, okay, let's add everything up except those two accounts. Here's the fund balance restricted. We're not going to add up the fund balance outstanding. I'm going to leave it alone. I'm going to add this one plus this one plus this one. And again, the debits and credits are netting each other out here. And that gives us the same amount. Why? Because the two yellow accounts cancel each other out. Debit and a credit cancel each other out. So they won't be included in the double entry accounting system.